This is the first set of slides that you're going to listen to outside of class. It is combining chapters 4 and 5. Chapter 4 talks about things that are included in gross income. Chapter 5 talks about those same items and when they're not included in gross income. So I have simply included them together. You need to know when your wealth has increased, if that has to be included in your tax base, because that's a whole different situation than your wealth increasing and it not having to be in your tax base. We like tax-free income much better than taxable. So after you've listened to these slides, they cover about half of chapters 4 and 5. Then you will go on to Blackboard and you will take your first Blackboard quiz. And then when you come to class for your second class, you will start out with a question and answer session. You have no questions, I will have no answers. And then you and your group will do a quiz based on the same material that you've seen here. And then we'll do some more work on assignments. And then you will have your own mini test at the end of class. Those are individual. And they will cover some of the concepts that have been here. So it's a good idea to pay attention to the examples, to do the related homework, and to spend as much time as you can, because Thursday night you'll be tired, it will be long, and you want to be as prepared as possible. We're going to start out with some basic information and definitions. That little squiggly there in front of the number 61 means that we are in a section of the Internal Revenue Code. This particular section defines what gross income is. You're not going to find it a particularly helpful definition because the answer is almost everything unless we tell you it's not. But we've got several slides coming up to cover that. And then we're going to talk about the ways that tax cash and accrual is different than GAAP tax and accrual. It'll be important for you to identify and understand the distinctions. So, section 61 starts out, and this is just a straight cut and paste, except as otherwise provided in this subtitle. A subtitle is a part of the Internal Revenue Code, and I showed you how big that thing was last class. In that subtitle, they talk about gross income means all income from whatever source derived, including but not limited to the following items. So they give you a specific laundry list, but note the but not limited to. So if your wealth increases, it's your job to figure out whether or not it is gross income or not gross income. And sometimes the distinctions can be a little painful. So compensation for services. Everything that you get paid when you work for someone will be income. We won't spend a whole lot of time here. Under fringe benefits, there is discussion in Chapter 5 that talks about sometimes your employer gives you a benefit that is gross income, and sometimes he gives you a benefit that is not. And you'll once again want to be able to distinguish between fringe benefits that are included in the tax base and fringe benefits that are not. Gross income derived from business, that is Thelma in tax return 1, and then in the flow-throughs also later. We won't spend a whole lot of time in the distinctions because business income for the most part will be the same no matter how the entity is put together. And then dealing in property, that's your capital gains and losses. We're going to save that till the very end of the course. So any references that are made in the earlier chapters, you can pretty much disregard. And then there's interest income. We've got slides coming up inside this chapter to talk about when interest is gross income and when it's not. Rent is pretty straightforward. Someone pays you money for the use of your property. Royalties are someone paying you for use of either your intangibles, like your brilliant patent, or they dig up a gold mine on your property and you get a percentage or a royalty for all the gold that they sell. Dividends, we've got some slides coming up to talk about those. Alimony, that will be in the second set of PowerPoints, and we'll talk about some of the issues there. Annuities are also in the second part of this set of PowerPoints. They are a complicated area, and you will want to spend some time dealing with those nuances because they are a guarantee to show up on a mini test. And then the list just goes on. Income from life insurance and endowment contracts. In the back of Chapter 5, you're going to learn that when somebody dies and leaves you income from their life insurance policies, that in itself is not a gross income event. However, there are things that are way beyond the scope of this class that you could do with your life insurance policies that could cause you to have an includable event. Pensions, we simply don't have time for those at all. We'll talk a little bit about Social Security. We will do the math on that, but we will not get a chance to get to much else in that area. Income from discharge of indebtedness is discussed in this area. Sometimes when you walk away from debt, it's a taxable event. Sometimes it's not. Make sure you read the book. We do not cover absolutely everything in the PowerPoints. They are not if it's not on the PowerPoints, I don't need to know it. That is not this class. So if you see a question about income from discharge of indebtedness, that is a sign that you're going to need to go and look at an example. Partnership gross income, the only thing we're going to do with that is tax return 3 is a partnership or limited liability company. We're not going to do any partnership returns. We're simply going to know how to deal with them on an individual's 1040. Income in respect of a decedent, in the year you die, assuming that you don't die on exactly 12/31 with no outstanding income to be collected, there will be a bifurcation of your income. All the monies that you earned prior to your date of death will be in your last tax return, regardless of whether you were paid before you died or not. And then all that property you have that continues to earn income while you are in the process of, well, not you, but your heirs and beneficiaries are in the process of distributing on all of your assets. Any income that's generated will be income in respect of a decedent, and that will also go on your 1040. Income from an interest in an estate or trust. There was a brief discussion about estates and trusts in that first set of PowerPoints. Once again, we really don't have time to go there. It is another flow through, and the beneficiary will have an income inclusion similar to what we're doing with the partnership and the S corp. Business can be fairly complicated, so the ways that you get your income can be complicated too. So you have to measure things at their fair market value at the date of a transaction, even if that's not exactly the amount of cash you collect. So I've got lots of different things. The first one is the substance over form, which means that if you have income, you can't call it something else and say, therefore, it's not income. Right? I didn't get interest from the bank. Instead, I got a toaster from the bank for opening an account. Well, why did they give you the toaster? Because you opened the account, and so it's a form of interest. Debt relief, when you owe less at the end of a transaction, is the same as if you were given the cash and you yourself paid the bank. In-kind receipt of property or services, if you repair my car and in return I mow your lawn, we both have income, and we have to value what getting my lawn mowed or the car repaired is really worth, and we have to include that in income. And then benefits transferred to another simply says that I cannot have my company write a check to my son and have that be income to him and not me, because it's really my income, right? I've just directed them how to write the check. And then windfall games, you know, the old sitcom type of situation where you get into the taxi and there's a suitcase in the taxi and it's full of mob money. If you keep it, the IRS wants their share. So if you keep it, you could have the mob and the IRS coming to get you. So be careful when you get into those taxis. The cash equivalent doctrine simply says that you can't wait until you convert your property to cash before you have a taxable event. So cash, clearly the measure. If you get property or you get services in a transaction, as we discussed earlier, you have to value them and report their cash equivalent as gross income. And then we've already talked about debt relief again, right? If you walk away from debt, you owe less, then you have to figure out how much to include into your gross income. The constructive receipt doctrine is a major difference from GAAP. If you have the cash, you have the property, you have the services, as far as the government's concerned, you have got gross income and you need to include it in your tax base. There is no such thing as unearned revenue in your tax accounting. So if it's been credited to your account, set apart, made available, secured for you, You could have had it if you just would let them know that you're coming to get it. All of those are indications that you have current gross income as a result of the transaction. It's not constructive receipt if there are substantial limitations or restrictions. Substantial limitations or restrictions is a buzzword. If you see that in a quiz or a test, you need to once again read about it in the book. There are some lengthy discussions about when you have to include, you have constructive receipt and when you don't. We'll deal with it a little bit. You will need this information for the corporate course. So if you're going on, take the time to read it. Don't just wait to see if a test question shows up. Claim of right doctrine is the same idea. If you have the cash, even if you have the cash in error, you have a taxable event. So the latest when it's received, you have the cash, you have the income. And once again, that unrestricted right to the funds. Even if it's received in error or the right to income is contested. So you sign a contract and then they hear about your really bad reputation and they say, we don't want you to do the work for us anymore, but you've got the money. You know they're going to sue you. You know you may have to give it back sometime in the future, but you still report the income today. And then there are some nice complicated methods for making sure that you don't pay taxes at a higher rate if indeed you have to give it back in year 4 when your tax rate's different than the year you included it. You need to know now, you probably already know, having been with me a week, that tax is messy. Almost every rule has more than one exception. For the most part, we're not going to cover all of those exceptions because our brains would explode, and we only have 14 weeks in total. So note that all you know is the tip of the iceberg. You need to be very, very careful. All right. So everything I said on the last couple slides about advance payments, you own the cash, you own the income, well, mostly true. All right. There are times when it's not going to be the case. It's important to note that this rule applies to both cash and accrual taxpayers. Remember, there is no such thing as unearned income on your tax basis, even if you are accrual tax basis. There are exceptions, though, and one of the major ones that all textbooks cover are security deposits because you have this obligation to repay them. Remember, we talked about an unrestricted right to the funds. The security deposit has to go back at the end of the rental period, or, excuse me, it is claimed and used to repair damages that you have made to the property. All right, just a little bit of an intro to what we're going to do next. We're going to talk about the tax formula. This will be old news for most of you because you've already done tax returns 1 and 2, and you're probably working your way through 3 and 4. But we do want to talk our way through it just to make sure that everybody's on the same page. And then we've got some inclusions or exclusions from gross income. And we're going to discuss some of those topics from the include, exclude at the same time. And we'll talk about earned income, dividends and interest income, and conduit entities. That's the material that we will cover for this set of PowerPoints. And then we've got a slew of other equally important items that we've left for the next set of PowerPoints. And then at the very end, there are some laundry lists of things that are strictly exclusions from gross income, those qualified fringe benefits that are a large part of Chapter 5. So don't forget, just because it ain't in the PowerPoints doesn't mean you can exclude it from your memory. You're responsible for all of the assigned work. I do base the questions on the mini tests from assigned homework, from PowerPoint, and group and individual quizzes. All right, the Form 1040, you've already done it. You have, by the beginning of our second class together, you will have completed one Form 1120, the corporate form, and one Form 1040, Thelma Tax Return 2. But I want to go through and talk about the individual pieces so we're all on the same line here. All right, one thing you will notice more we move to Chapter 6 and 8, that some personal items are deductible. Things like your mortgage interest have nothing to do with making money, but they're still going to be deductible. And then this concept of for and from AGI is going to be increasingly more important. We have to deal with it when we get to Chapter 3 because it's a wealth measure. If your adjusted gross income is over certain limits, the government starts taking away some of your tax advantages or raising your tax rates. 4 AGI is the last number on the front of the 1040. From adjusted gross income are those things that you would deduct on the back of the Form 1040. And then you already know that there are 12 billion tax rate schedules, right? Depending on your entity, your marital status, all of those things have to be taken into consideration. So make sure you always get to the right tax rate schedule, because you wouldn't want to have a brilliant tax calculation for a single person when the person was head of household or something else. So we start with the front of the 1040, because remember, adjusted gross income is the last number on the front. You're working your way through chapters 4 and 5, doing the homework, reading the book, because some things that increase your wealth are gross income, others are not, and you want to make sure you know the difference. And then you will have noticed when you did tax return number 2 that a lot of the numbers on the front of the 1040 come from schedules where both income and deductions have been reported. And so all of them as business deductions on our Schedule C are considered to be deductions for AGI because they come to net numbers on the front of the 1040. And then there is that box at the bottom of the front of the 1040 where individual items like half self-employment taxes and other items get deducted for AGI. And so we refer to both the Schedule C deductions and the pension deductions as being for AGI. That will give you your adjusted gross income. Having turned the page, you will note that the last number on the front of the 1040 is the same number on the back of the 1040, the AGI. You start doing some subtracting, and your government assumes that you'll do a better job of subtracting, at least back when they were paper returns, if you could see the number you were subtracting and not have to keep paging back to the front. So these deductions from AGI come in 2 flavors. The first is your standard or itemized deduction. We've talked a little bit about the standard deduction. We'll spend more time on it when we get to chapter 3. You will not be responsible for itemized deductions until we get to chapter 6 and 8, which are a few weeks down the line. And then personal independency exemptions. So we'll discuss those at length in the chapter 3 PowerPoints, but you already know what those are, right? It's a dollar amount. I tell you how many exemptions there are, and you simply do the math. So all the way through tax return 1, 2, 3, and 4, Thelma is single and has no dependents, so she gets to subtract 1 exemption in her calculation of taxable income. And once we have the taxable income, we're ready to do the tax liability. And the regular tax liability, you've now had several exposures to that, gone through the PowerPoints, done it on the tax returns, and you'll never guess what you're going to do as part of your first mini test. So be prepared. We know that it's based on taxable income and filing status. Here we're talking about the Form 1040, so filing status is important. Taxable income, is it ordinary income? Is it qualified dividends? You're responsible for those distinctions at this moment. Later on, we'll add the taxes on capital gains and losses. And then there are other taxes. And then you reduce by credits and payments, and that gets you to a balance due or a refund. So for now, everybody should be able to do self-employment taxes. You did those on tax return 2, which was due before class. Credits and payments, not so much yet, except for payments, right? We've dealt with estimated tax payments and with withholding, and that gets you down to a balance due or a refund. And then you have finished the Form 1040. Said we talk a little bit about earned income. That's the salary and the Schedule C income, those kinds of items. Sometimes they're earned and taxed in the same period. Other times they are earned and taxed in different periods. And retirement contributions, retirement earnings are a prime example of that. Both the pension, which we said we wouldn't have much time to get to, and the Social Security, which will be one of your major calculations for this set of PowerPoint. So next, I just have a laundry list of things that are generally concluded, right? Cash for market property, bonuses, tips, sick pay, severance pay. They fire you but give you 2 months pay. Then there are other benefits you might get that might not feel like they should be part of your compensation, but they are. If you have personal use of an automobile, you drive it back and forth to work, and then it's the company car, you use it all day at work. You probably have an includable event, but read Chapter 5 carefully because there's always an exception here. Personal expenses paid, your family goes on vacation, you go on a business trip, and you are allowed to take your family with you, and the company pays for the airline ticket for your spouse, probably a taxable event. Moving expenses paid by your employer, sometimes they are, sometimes they're not. We will have a tax return where we have someone with moving expenses. You'll do the tax form, and you'll worry about whether they're qualified or not qualified. Unemployment benefits, they aren't even paid by your employer, and you're certainly not working, but they are a taxable event. And then excess fringe benefits. Excess is above what the government says you can have for free. Right now, they say you can have all of your medical insurance paid by your employer, and there is no cost to you for that. That rule is going to change for very, very fancy programs, and it's one that's frequently targeted by politicians because sometimes that medical insurance could be worth several $1,000s, and the government feels if it could tax it, it would go a long ways to solving some of the revenue problems. Make sure you read the back of Chapter 5 to know what excess fringe benefits are. And then deferred income, pensions and retirement. I said we aren't going to go there. We just don't have time. But I do want to remind you that anytime you get a chance to save with pre-tax dollars, you definitely should do that. All right, we're going to talk a lot about after-tax return. It is an important thing for you to try to get at all times. And then when you save with after-tax dollars, that means that if you earned $1 and your tax rate was 30%, you give the government 30%, and then you only have 70 cents left to invest. Much nicer to be able to get the entire dollar into your earning pool. And then, well, a lot of times when there's after-tax dollars, we're talking about annuities, and those formulas we'll discuss in the next set of PowerPoints.